all of y'all cousins out there. This is Dr. Jake Taylor with the Back End Warrior podcast, where we teach you all the real back end on insurance, private banking, business, and lifestyle. One of the biggest things I want y'all to understand. Hold on. I think we're echoing over there. Okay. One of the biggest things I want y'all to understand is that, hold on, let's stop right here. Hey, listen, everyone on IG, unfortunately, you won't be able to participate because you're messing up my flow. So what I want you to do is go to my YouTube right now and check out the rest of the show because y'all just won't be able to participate. We got to go.
Did you link it up, Jake? Did you link it up
Yep.
in like the description? You put the link to your YouTube down there?
Uh-huh.
Okay.
Yep. All right, so listen, I've been waiting to get some of this with you live. This is going to be fun. We're going to see a bunch of people start kind of piling in over here. But here's the deal. Chris, man, you know, I got to know a little bit about you over the couple of days, but I need the people to know not only who you are, but what made you become so dragon-like when it came to when it came to producing smokage for people that's on when it comes to private banking and IULs. So just a quick, I'm gonna make it easy for you, but just a quick update. Like, who are you? What makes you so A.L. Williams like? And let's start there.
Yeah, man. So man, where to start? I guess I'll give a quick backstory. So I spent my 20s being a professional poker player. I don't even know if I told you that yet. But I was top 100 ranked. At my peak, I got up to number 64 in the world playing online poker. Killed it. Made more money in my 20s than most people could hope to make in their life, pretty much, I think. And the problem is I got out of it with nothing, like literally nothing. Because I grew up with nothing. I grew up in a trailer park, loving parents. Amazing. Like I really got nothing to complain about from that perspective, except for the fact that I had no financial education. And so I got through my 20s through some just poor money management, some unfortunate luck, and just bad decisions. All things considered, I literally hit 29 years old when I stopped playing poker, and I had nothing to show for it. And the government. Yeah, the government shut down online poker. The money that I did have, the government confiscated because they, what's called Black Friday in the online poker world, where the U.S. government shut down online. But I got into the financial space, and I loved it. And so my father-in-law had been a broker with Wells Fargo, Wachovia, A.G. Edwards. He was a money manager for them for, at the time, like 35 years. And so I didn't know what I didn't know. And I was just like, I want to get in the financial space. And he was like, well, why don't you come be my succession plan? I'm going to retire soon, whatever. And I was like, all right, that's cool. So, I walk into his office and I interview with his manager, Ray. And Ray was just like, Chris, listen, seriously, I think you're going to kill this industry. I think you're going to be amazing. But we just got through the Great Recession. And if I hire you right now, dude, you've been playing poker for a living for 7 years. You've never had a job. If I hire you, I promise you they're going to fire me. So I can't do it. And I'm like, well, what do I do? He's like, well, go get a job in an insurance company. They'll hire anybody. And so I was like, all right, what do I do? And so I was living in Vermont at the time because that's where I'm from. And my wife and I had moved back to Vermont. And so I was like, what am I going to do? And National Life Group was the natural place to go. So I went down to National Life, became an agent, and got Rookie of the Year my first year. As you know, once you start having success as an agent in this business, you start they're like, hey, you should start managing people and training and recruiting, and you just start going through the ladder. And before you knew it, I was the director of business development and training people, recruiting people, going all over the country, doing my thing. And it was quite the ride, honestly, for 4.5 years. And if you know anything about National Life Group, they're they're the #1 IUL company in the country right now. Back then, we were pivoting between number 2 and number 4, depending on the year. They've really, really taken off and kind of dominate the marketplace now as far as IUL goes, which is sad. We'll get into that, I'm sure. But ultimately, it was my experience there and my evolution, my growth with them exposed me to higher level people, understanding the product on a different level, getting access to people in the company that most people don't get access to. So I got to ask some really tough questions, learn the truth about what was going on, see some things that were going on behind the curtains that I was not impressed by. And honestly, it was a real conversation that I had with a guy named Don Blanton, who is the founder and I guess he's not the CEO anymore, but he's the founder of a company called Money Tracks and Circle of Wealth, which is a sales system. And it's all about utilizing life insurance as an asset. And it was him that prompted me to start asking the questions about Index Universal Life, to dig deeper. And because on the surface level, I drank the Kool-Aid, hook, line, sinker, if that's even a phrase, but like, you know, I'd done that and was all in on what it could do because I didn't know what I didn't know. And so he got me to ask these questions. And when I started asking the questions to the right people in the company and started getting the answers that I was getting, it was like, wow, this is not what I thought it was. I remember coming home, talking to my wife and being like, I can't do this. Like, this is, I'm hurting people. I don't know what to do. By the way, they just offered me a ton of money, like multi-six-figure bonus just to move, to take over an office and build it out and like allow me to get off the road and stop traveling as much because they knew that was bothering me. You know, so I turned down and walked away from a lot in that moment in time because of the fact that I can't do anything I don't believe in. And what I realized was what I believed in and all the principles and the philosophies and the foundational asset that I really believed in that I didn't realize it was whole life insurance, you know? And it was, probably a year and a half journey to like really have that all play out to where I discovered that IUL wasn't what I thought it was, started going down the path of learning, and then found that whole life was really it. And then, as you know, you go down that path and you start like digging deep. And then the more I learned about it, the more passionate I became about it. And so now my excitement every day is to get up and help people understand how to structure their financial life for success. And, you know, to make sure that, you know, start with the end in mind, start by figuring out what are your goals? What are your objectives? They're different for you than they are for me or Jake. But the bottom line is principles of success don't change. The principles of money don't change. They're not negotiable. There's no free lunches.
That's right.
You know, and so I just love helping people with it now and coaching people to it. And that's why I do everything I do on my channel.
Listen, so, okay. Oh, there's a lot to unpack. Okay. Listen, Chris, you're the first interview ever. So this is like go to kiss. You're like go to kiss right now. So listen, here's the deal. So we got to start with this. The insurance industry will hire anyone.
That is
because
true.
what happens is a lot of people think that, man, just because I got my license and just because someone has their license, that means that they know exactly how to structure a policy, ensure that my family's taken care of, make sure everything is, you know, in the right places, when in truth, that's not the case. And so I'm going to sit back as the audience and ask questions as if I was a novice, all right? So what is typically, how long does it typically take for someone to actually get a license in the life insurance industry, like realistically?
Oh my gosh. I mean, that's like such a loaded question. It depends on the individual, depends on their drive and free time. But I'll tell you my story, right? I told you the story. I went into Ray's office and I was like, what do I do? And he's like, get a job with an insurance company. And I was like, okay. I went home that afternoon, found a course to study. 9 days later, I had studied, passed the test, got my license. And it took me 9 days from start to finish to get my license.
Dude, so, all right, let me tell you my story. I got recruited at a Starbucks in Mesquite, Texas.
Nice.
Yeah. So a guy by the name of Tony Stevens Sr., who is still my mentor to this day. He's like a godfather to me. But it was with Primera. It was with Primerica. And he sent his son, who's like a brother to me, to a table because I was actually talking to a client of my own. For when I was kind of doing a little bit of consulting. And so Tony Jr. came to my table. He's like, hey man, you know, you look sharp, and we saw you drove up in a nice car, and you know the whole pitch. You know, you're looking to make extra income, and I shoot him off. I was like, dude, get out of here, guy. Just get out of here. I'm fine. Yeah. So I walk into the Starbucks, and Tony Stevens Sr., like I'm looking at him like, you know, a high level cologne seller, you know, the ones that sell cologne. I love it. We're in the middle of the summer, Chris, and he freaking has a leather jacket on, boots, cowboy hat, jeans on. So he's like, hey, young brother, let me talk to you. And I said, sir, no offense, I don't want any cookies or cologne. And he said, he said, what do you think I do? I said, I don't know what you're selling. I don't want none of it. He said, what if I told you that what I was selling, I was making $50,000 a month? I said, well, we may be talking. But the first question you got to answer is, why are you wearing a leather suit in the middle of the summer? He said, young brother, I don't work in the heat.
Nice.
So, you know, he showed me his 3-month paycheck stubs and, you know, all of that. And I got recruited. I got recruited on a Wednesday. I mean, on a Tuesday. I went to class that weekend, passed the test that next Wednesday. So around 7 to 9 day range too, which lets us know that it doesn't take that long for someone to get licensed.
Yeah.
And yeah, go ahead.
No, that's all it comes down to. How motivated are you? Like, you can get it done real quick. Like, you can take as long as you want or short as you want. That's really what it comes down to. So,
dude, so when you are sitting down and you're talking to insurance agents, how are you able to tell if they actually know what they're talking about versus regurgitating information that they're using as their sales and marketing strategy?
Oh my gosh, that is a loaded question. So here we go.
Oh, I told you this is gonna be the best interview you ever had.
Wow, this is gonna be deep. Okay, so how do I tell if an insurance agent knows what they're talking about or is just spitting, regurgitating like a sales script? Like, okay, so you just have to know the questions to ask. Like, when you're saying this, you're talking about IUL specifically.
Yeah. Yep.
Okay. So, so Index Universal Life, there's a lot of people. I'll use an example. So I had somebody last night. I woke up this morning to an email, and in that email, it was a woman who had a policy illustration, and she was like, "Chris, I've been watching your videos. I know you say you're willing to do reviews for people. This is my situation. It had to have been a WFG policy because just of the company that it was, and the way it was done. Like you learn to see it, you know. And so she's like, "Can you tell me?" So she forwarded me the email and the PDF illustrations that the agent gave to her. And in the description, in the email copy, it was basically like, here's your illustration. As you can see, you're going to get 6.2% per year. Plus, you're going to get, if you fund it fully up front, you're going to get a 2% bonus because they're using a multiplier inside of the IUL. And so all these different things, right? So they're saying you're going to get, this is what it's going to be. This is what it is. Now, the agents that just regurgitate, they talk about high-level concepts that are very, very I don't know, just high level and very
vague
and focused on the positives and stuff of that nature. So, you know, the conversation of IUL is upside potential, downside protection, you know, participation in the index, you know, so you have all the participation, but none of the risk of the index. And that sounds like really good. And so therefore they tell you that the illustration is conservative because there are regulations that surround it, you know, so they talk about these things in a way that they don't even understand themselves, but they only say that because they're like, hey, this sounds good. And guess what? Like, I'm not judging them from that perspective if they're new in the business, because if I was judging them, I'd be judging myself 12 years ago. You know what I mean? Like, because I did that, you know what I mean? And so I get how it's easy to fall into that trap and buy that story, you know? But here's the deal. Those agents, the agents that don't know what they're doing, they focus on that high level stuff. They sell on the illustration. They sell with basic assumptions. They make these basic assumptions. Now, if you want to know if that person really knows what they're talking about, ask them how it all happens. Ask them how all these things come together. Okay, you say I'm going to get X return in the index, and that's going to be the average. Why is that the average? How am I actually, if you say I'm participating in the index, how am I participating in the index? Like, how exactly does that happen? Now, some agents will say, oh, well, they use an option strategy. Okay, that's great. So what they do is like people, and this is what Curtis Ray does, right? Like, so he goes and he says, listen, you use.
Hey, hold on, wait. This is why Chris is my brother. Okay, for the people that is freaking absolutely destroying families with their marketing tactics for sales. Hold on, for sales and commissions. Chris gonna call your butt out, and that's what I love. Olivet Payne said, "I love Chris." Me too. I think I love him too. Hey, have you ever seen Love at First Sight? I think this is what it is here. I feel it. I feel it. After my wife is Chris, I promise you. All right, so Chris, go ahead, brother.
So this is what Curtis does. Like, he's like, oh yeah, we use an option strategy to get all the upside and not have the risk or whatever. It's like, but he doesn't go into the next level, right? Like, I was a big believer, you got to ask and get levels deep, right? Like, you can't just focus on the surface level. And IULs are highly complicated products, period. And
yes,
you just buy it based on the surface level BS that these guys are selling you, you're going to get what you get. You know what I mean? Like, you have to, this is why I always say, listen, you are where you are in life because of who you are in life, right? Like, your understanding of things. If you want to elevate to another level, you have to become more. You have to learn more. You have to dedicate yourself to educating yourself about this stuff. So if you make a surface level decision with your finances and the products that you buy, you're going to get surface level results. And that means you're going to get 95% of the people in the world have is that it means you're going to get to retirement. You're going to have no dignity. You're not going to have your finances set up properly. You're going to hit this recession or potentially depression that we're coming into, and you're going to get smashed. And you're going to be like most people, you're going to be focused on surviving instead of thriving. And like, you have to be positioning yourself to take advantage of the opportunity that's going to come. A lot of people, sadly, I had another person last night send me another illustration, completely different story than what I was just telling you. And they're telling me like they got this policy and they're like, okay, I put $9,371 into this policy. I already went through it this morning with them. $9,371 into this policy, right? And they're like, what are my options? It was a national life policy. Like, and they're like, what are my options? And I'm like, I don't know what your options are. Like, I don't know how long you've been funding it. They're like, it's been a year. And I'm like, well, like, they didn't even send me the illustrations. They're just like, this is what it is. I'm like, well, what's the surrender charges? They're like, I got my surrender value is zero. So I'm like, you're screwed. Like, you are
getting no money.
You got nothing. And this is the thing. That is something that would never happen with a whole life policy if you work with somebody that knows what they're doing. It's impossible.
Okay, stop. Okay, stop. Because we got a lot of viewers on here that are becoming new to private banking. They're new to insurance. They're new to this concept of dumping cash into an insurance policy. So can we break down what exactly is a surrender charge and why is that a big deal when it comes to being able to get access to your capital?
All right, so this is a great question. Okay, so it's probably my favorite question actually. So the when index universal life policies are sold, there's a couple components. This is a hard one to break down simply though. So when you look at an index universal life policy, let's just say for the sake of like easy round numbers, you're paying $10,000 a year into a policy. Okay. So when you're paying $10,000 a year into a policy, the insurance company starts you off with a high cap rate, right? Or a high participation rate or, good performance in the policy. It's never going to be better than the day you buy it as far as like what the features are inside of the policy. And so what happens is as it gets older, the life insurance company knows that they can't manage those cap rates and the participation rates and all the things. They know that they're never going to be able to perform according to what it was illustrated at. They know before you buy this that it will never perform as you bought it. They know it 100%. I promise you that. So they know it. So what do? They have to add surrender charges to your policy, because what happens is there's two columns. There's a surrender value column, and then there's a accumulated value column. The accumulated value column says, this is the amount of money you have here. It's kind of like that carrot they dangle in front of you that says, hey, if you just hold on long enough,
don't quit.
Here, if you quit, this is what you're walking away from, that kind of thing. So uneducated people, naive people just keep going, right? Because they go, hey, this is the amount of money that you're earning your interest on, but this is how much you have. Nothing, right? For this guy with $9,371, he's got like 7,000 over here, but he's got nothing over here, right? In the surrender column. And so he's like, well, if I give up, I lose this $7,300. Well, guess what? I'm a big believer. You should never throw good money after bad. Sometimes, always, I got news for you. Education is not free. And so for him, I said, listen, you can keep throwing good money. It's not going to impact my life. You do you. It's up to it's your call. But if you want to do this, you can keep spending to try to chase that accumulated column. Over time, what happens is the insurance company reduces the surrender schedule, so more of that money becomes available in the surrender column. However, what happens is over time, they do that, and they know it. They reduce cap rates, they reduce participation rates, they do everything they can to reduce the performance of that policy. Now, I know a lot of IUL agents out there go, Chris, that's not true. That's not the way it happens, blah, 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 blah. Here's the problem. Most IUL agents haven't been doing this business more than 3-4 years, right? I created the IUL challenge because I was sick of everybody saying, Chris, that's not really how it works.
Wait, Chris, wait. If we gonna give them the smoke, Chris, we gotta slow it down for them. Okay. Sorry. Okay. So just in case you all didn't know, okay, Steve, are you listening? Okay. So just in case you all didn't know, Chris Kirkpatrick with Life180 is so bold, kind of like Cousin Jake, is so bold that he said that if your policy is what you say that it is, I have an IUL challenge that says that I would pay you a specific amount of money if your policy is doing exactly what your agent said that it would do. He even opened it up to agents, right, Chris?
I mean, it's geared towards agents because I'm sick of agents telling me it can be done. Listen, let's talk about this real quick, okay? I want to hear, what is the context, the premise of why agents believe in IUL and how people are sold on IUL?
Oh, it's very simple. You got a cap with 0% floor. There's no way that you can absolutely lose, because even if the market happens to become the worst of the worst markets, you can never get below zero.
Right, exactly. So, and you have the upside, right? So you can upside
protection.
The market does up to, if I got a 10% cap or an uncapped index, right? Like you could get whatever you have on the upside, but you can never lose your money. So maybe your upside isn't as high, but you can never lose your money. And so that's how it's sold. And that sounds like this amazing story. Well, I got news for you. So this is why I did the IUL challenge. This is the foundational context of why I did it. Because A, it never works like that. They never perform the way they're sold. And if in fact you have upside potential, right? If in fact you have upside potential and it's going to be this great tax-free income vehicle when you get later in life, when you hit those distribution years, if that's the case, we just came through the greatest bull run of all time, right?
Correct.
I don't think that is not disputable. That is a fact. Fair enough?
Yes, facts. Okay,
greatest bull run of all time. What is a bull run? I interpret a bull run as upside, don't you?
That's right. The market's going up.
So greatest bull run, greatest upside potential that we've ever had in the history of the indexes. Yet IUL policies still didn't perform as they were sold over the past 10 years.
Wait. So you're telling me, Chris, because I'm sure the viewers want to know this.
Yeah.
So, Chris, you're telling me that during the greatest time and probably one of the greatest times in American history, as it pertains to the market growth, that IULs did not perform to what they were projected to perform during 100%. One of the greatest times in American history?
100%. And here's the deal. And this is why I did the challenge, because I was sick of all these people on TikTok and Instagram and YouTube selling IUL as this magical financial vehicle, when the people that are selling it don't even know what they're selling, A. And so I said, listen, I don't care about your opinion. I'll tell you what, I don't even care about mine. Like, in this context, just what I care about are facts. So I'm going to start this challenge and I'm going to see what happens. So I started it off at $500 and I said, all right, anybody that can show me a policy that's 10 years old, where there was the original illustration through the greatest bull run of all time, and then show me an in-force illustration that technically on paper should have destroyed the original illustration because we've gone through this great market. So if you're taking advantage of all the upside, you should have better results, right? And so I said, listen, I'll give somebody $500. If somebody could just show me one policy, I'll give them $500. Nobody was doing it. So I said, you know what? Maybe $500 isn't enough. Maybe it's not. I'll give them $1,000. Maybe somebody will give me, maybe it'll be worth their time if I give them $1,000. I mean, it'd probably take somebody 20 minutes to pull it up. So that's like $3,000 an hour to pay somebody to give me, like, to prove me wrong. And plus I on top of that, even more valuable, probably, I said, I bring them on my channel. I interview them. Whatever. And guess what? Nothing. Like, nobody. I've had over 700,000 views of videos with IUL challenge in it, focused on that, talking about it, pushing people, and not one person has been able to step forward. Now, here's the deal. I want to preface this with this, is that I'm not saying it's not possible that an IUL would have outperformed the original illustration, because there certainly are some things that you could have done to make an IUL perform the way that it was sold over the past decade. What I'm saying is we need to have a bigger conversation around this, right? What I'm saying is that if it's sold in this thing that it's just so predictable and so guaranteed and so the way it is, right? Maybe not guaranteed, but so just like dependable. If that's what it's sold as, I would think that at least 80 to 90% of the policies sold would have outperformed. But the reality is less than 1% of the policies sold over the past decade actually hit performance as they were sold. And that is the problem, is that people need to dig deeper and understand what they're buying, what they're putting their money into. And that's why I do what I do, just to expose people. And I think when people buy it, what they wind up, when you really start to unwind this and understand why you did what you did, why you put your money into it, and what your expectations were, what you were hoping for, what you wind up with is saying, man, I should have just bought a whole life policy. That's what I think.
So there are two things, right? The first thing is the exception should not become the standard. Totally. Because there are people who structure the policy in the right way. But the thing that I hear IUL agents say the most is it got to be structured right in order for it to happen. And let me tell you, IUL agents, clicking type B for the death benefit doesn't necessarily make it structured right. So can you talk about that, Chris, for those that's like, it has to be structured right in order for it to actually do what it's saying?
Yeah, first of all, let's talk about what structured right means in their mind. It means minimum death benefit, maximum cash accumulation, option B. That's it. It's that simple, right? And so so in their mind, that means I'm jamming as much money into the cash. I've got the smallest death benefit possible. We're doing an increasing B. Option B is an increasing death benefit. And that means as the cash accumulates, therefore, so does the death benefit. And what that allows, what that enables, according to actuarial code, that it enables the policyholder to put more cash in year by year based on the death benefit. So it technically makes it more efficient, which is true. It is true from that perspective. However, what they don't tell you is that even if you properly design a policy, it's still not going to perform the way you bought it. Okay.
No. All right. No, wait.
Okay, sorry. Go ahead.
No. Go. You're good. All right. So listen. Because somebody brought up Doug Andrews, so I gotta let you tear into that one.
This is gonna be fun.
Somebody brought up the Laser Fund by Doug Andrews
on the live.
Huh?
Sorry, I was talking to my video guy. Asking him to hop on the live.
Yeah. We got to talk about Doug Andrews, and it's over 60,000. and there's over 60,000 lawsuit cases. We're gonna talk about that in a second, okay?
Yep.
We're gonna talk. We gotta talk about PHP. We gotta talk about PHP, WFG, and all of them. Listen,
This is gonna be a long
listen.
video, y'all. I hope everybody's strapped in. Get lunch, get ready. It's gonna be fun.
All right, so look, but I do want to go back to your back history.
Okay.
Because you have a specific set of knowledge about the IUL that the average agent wouldn't be privy to having this information. You and I talked on the phone yesterday, and you said you weren't going to say certain specific names in that realm, but you were open door with the actual concept of actually breaking down why these policies were never created for the actual client. So can you talk to us like you used to actually work behind the door with a top 1,000, a Fortune 1,000 insurance carrier? And can you tell us why they actually created the IUL and how it was not for the client?
Yeah. So here's the deal. It's no secret. So let's do a little history on UL, right? So, UL was created in the 70s. It got kicked around a little bit. A company called DR Horton made it more popular, right? And got it some pub in the early 80s. UL had it took off. It gained a lot of market share. Universal Life, traditional Universal Life, gained a lot of market share in the 80s because we were in a really high interest rate environment. The illustrations looked really good. But the problem was the illustrations, once again, with traditional UL never performed because they just never do, because of the interest rate environment, because of the crediting strategies, because of how they just work internally with the fees and the structures and so on and so forth. Nothing is guaranteed for the policyholder. What happened was they had a massive uptick and then they had a massive downtick where policies were lapsing. They stopped getting sold because the environment changed, all these different things. Now, then there came out with VUL and GUL, variable universal life and guaranteed universal life. All these products have had waves of popularity and then a dissension from popularity because they just are sold on hype and then they never perform. At the end of the day, index universal life was created by Transamerica in 1997, and which I think is funny because a lot of people, Doug Andrew included, really touts on the fact like this product has been around since 1997, which at its core, by the way, I don't know if you know this, you may, but like probably most people watching don't. Roth IRAs were created in 1998, right? Like, so they're pretty new. 401ks were created in the early 80s, late 70s, where they became popularized, right? Like
70s.
So this is all like we're hitting the first generation of people that work their entire lives with these strategies and are not able to maintain their standard of living, right? Like the first generation of people that work their entire life with these philosophies on these products and whatever that are, quote unquote, the traditional methodologies. And it's failing to the tune of we have the most prosperous country in the history of the world, and 5% of people, 5 out of 100 people are able to retire and maintain their standard of living in the most prosperous country of all time. So think about how broken the system is. It's busted. And so when it comes to IUL, when it was created in 1997, Transamerica had it, but it had less than 1% market share until 2009. Think about that. 2009 happens, and it goes from having less than 1% market share to just like skyrocketing and just like this hockey stick effect on how popular it was because of what happened. The upside potential, downside protection story, right? Now, IUL is what? It's a universal life product. That's the UL part. The index is participation in the index. So when this is the bastardization of a comment or the philosophy or the foundation of what index universal life is, they say upside potential, downside protection. Well, it's upside potential compared to, not upside potential because, hey, you get to participate in the markets and all this stuff as every IUL agent is selling it as. Go look at the MPI, Curtis Ray illustrations with Mutual of Omaha. I think it's page 11 on that illustration. You will see in that illustration that it says, when we say upside potential, we mean upside potential compared to a traditional universal life product. Because what we're doing is we're taking the crediting strategy that you would get on a fixed basis, and we're taking that and we're buying options with it. And you're risking that money. That's it. And so these were never designed to do anything, be as sexy as they're being sold as. They were never designed to be sold in this illustration war. You know, what's happened is in 2009, there were like 8 companies selling IUL. Now there's like 70 companies selling IUL. They've created their own problems. I could talk about this for hours, like as far as like all the problems that they've created on their own, just by the popularity of the market and the way the option strategies, you know, are impacted, and the fact that the costs of all the options make everything more expensive, and that has a negative impact on the actual performance of the policy. So the more popular they become, the worse they get. And that's just the reality. And that's just math. And that's just how the markets work. And when you understand that options, if you understand, this is why I always say index universal life is like putting lipstick on a pig, right? Like it's still a pig. It's a universal life product with an option strategy. And if this option strategy was so good in a world that that the company is having a hard time getting a 4% return in their general fund, if it was so predictable, so like steadfast with a strategy, why wouldn't the insurance company be doing it for themselves to get 6.5%, 7%? If it worked out, they'd be doing it for themselves. So what I tell people to do, stop buying BS, start using a little common sense. And when you do, and you dig a little deeper, you go, holy crap, this is not for me.
Man,
did I answer your question though? I don't know. I got a little.
No, but it was good. It was good. It was good. Y'all see his passion. I want you to tell us if you can. If you can't, we can move on.
Yeah, no.
But you used to work for a company.
Yeah.
That's the number one seller.
Yeah. Why did they do this, and what was it? Why was the rise of IUL and whatever? So here's the bottom line: is the rise of IULs. They knew they were coming into this low interest rate environment. There's a lot of risk on these insurance companies, you know, in this low interest rate environment. Remember, life insurance companies do one thing better than any other financial institution in the world, and that is preserve the purchasing power of your capital. Period. That's it. And so when you look at it from that perspective, they're always thinking long term, always. 100% of the time. That's what insurance companies do. And so I want to speak to that really quick. What do we always do, Jake? We tell people they need to think long-term with their money. And so when we do what we do, I'm a big believer that who I'm partnered with and whatever I'm doing financially, I want them to be in alignment with my values and my beliefs. Fair enough?
That's right. That's right.
And so
that's right.
No other financial institution in the world, except for participating mutually held life insurance companies, are going to be thinking long-term like I am. So I want to bring them into my sphere and have them be helping me impact my financial decisions and helping me manage that risk, because it's a huge component to it. Now, in that long-term mindset that the life insurance companies have, they were looking at this going, man, it's not looking good. Things are going to get worse. We need to get ahead of this. And so if you understand whole life insurance, all of the risk in a whole life policy is on the insurance company, because they have to give you guarantees. Now, they were scared about that, and they needed to create other revenue centers, because when you have a policy with a whole life policy with a participating mutually held company, the participating part of that means you participate in the profits of the company through the payment of a dividend. That's what it is. Now, that dividend is the participation of the profit of the general fund, the returns that they get, but also participation in the profits of all the profitability of the company as a whole, i.e. other lines of business, annuity profitability, term life profitability. And I got news for you, IUL profitability. And make no mistake about it, IUL is the most profitable business on the books of life insurance companies. And so life insurance companies created Index Universal Life because they wanted to offer a cash value product that looked really good, that had the potential, right? It's the same thing as UL, that had the potential to do it, and they could sell it that way, but it shifted the risk from the insurance company to the insured. And therefore they created an extra profit center that in case of emergency, they could break open glass and meet all the guarantees and the needs of the policyholders that they had to meet all the guarantees for.
Oh my goodness. Hey, listen. So Nala Day said Jake and Chris are the smoke kings. Hey, awesome. We should probably start a podcast called Smoke Kings.
We might get the wrong audience, but go ahead.
Oh, well, you know what? You're right. We may get the. So here's the deal. You know, a lot of IUL agents and clients hear from their agents. IULs, when it comes to their cost, you know, they're extremely transparent.
Yeah.
They are extremely transparent with their cost basis and the cost of insurance and their fees. Can we talk about how there's always an asterisk that and the costs that they show you are not fixed, they're variable, and how the insurance company can manipulate those fees for the benefit of the company to be able to not only sustain the general fund, but to pay out the dividends for their actual members that they have to come through on that promise. Can we talk about that a little bit?
Yeah, no. So this is a great one. So this is a fun one because this is one of the big selling points that IUL agents use against whole life, that actually you just kind of turn the gun back at them and they kill themselves. You know, like they're trying to shoot the whole life agent, but they end up shooting themselves because of the fact that they go, well, hey, listen, IULs are transparent because they show all the fees. They show the admin costs, the cost of insurance year by year by year by year, and what they are. And in whole life, it doesn't show it all. Well, I got news for you. In whole life, it doesn't show it all because what you see is what you get. You look at a column and it says, this is how much money you're going to have then on a guaranteed basis. That's just what you have. This is how much you have with current assumptions based on what the dividend rate is at the lowest dividend rate of all time. So I think it's actually going to be better because rates are going to go up. Like, it is what it is. In an IUL, they're trying to say, hey, we're so much more transparent. You can measure it and all this stuff. And so it does show all this stuff. But here's the deal. The reason they have to is not because they want to. It's because legally they have to, because of the fact that regulators say, listen, these are all variable costs that the life insurance company can change. So while they're being transparent about what they all are currently, the real reason they have to put that page on the illustration is because in the top corner, look real close, there's a little asterisk that will say these fees, every company does a little different, but it basically says all these expenses are subject to change and could get worse in, you know, could go against you, could get better or worse, maybe more or less favorable, right? But they're always less favorable for the policyholder, at least to this point in time, they have been, you know. So
and what I constituted as, Chris, is the marketing ploy from big corporations and the government when they got us out of pensions to opt into 401ks, because it was a much more beneficial product for the government as well as for corporations. And it took the risk off of the corporations to come through on what they promised to the actual employees that were working the 9-to-5, you know, job. So when you talk about the insurance company creating that IUL product, it kind of gives me almost like the flashback of the 401k being created, and shifting that risk away so that it can preserve the ones that want to play the insurance real game.
Dude, totally. So here's what that makes me think of. So when the government created this, it went from a defined benefit plan to a defined contribution plan, which is exactly what a 401k is, right? It went from the pension system to the 401k and qualified plan system. It basically took the average everyday employee that was just benefiting from some higher level organization like a corporation, having a department that managed your investments and gave you guarantees on the back end, right? And put them into the market, took every individual, put them in the market, right? And that's what really caused a big bump in the market. Or one of the things that caused a big bump in the market in the 80s is there's so much more volume that went into buying stocks, so much more money that went into that, because every day investors were going in there, right? Now, the problem is what you did with 401ks, or what you do if you're participating in 401ks, qualified plans, IRAs, stuff of that nature, 457s, 403bs, stuff of this nature, you are giving up control of your money. You're giving it to the government. You're becoming a business partner with the government because they can tax your money away from you at any point in time. Now, here's what I tell people. This is the massive hypocrisy of universal life, index universal life agents, is they sell index universal life as the alternative to the 401k for tax-free income, because it's like, don't be in business with the government. All you're doing is getting in business with the insurance company. And they go, well, the insurance company isn't going to stick it to us the way that the government is potentially, right? So you're telling me you trust the insurance company more, right? Here's the deal. Do you believe, Jake, that history has a habit of repeating itself?
Always.
Okay. So if you don't believe they're going to do it to you for an IUL, I ask you, I implore you to go back and look, really study the history of universal life and how life insurance companies handled their policyholders in the rise and fall of traditional UL is exactly what they're going to do with IUL. And I promise you, it's not in your favor. And so all you're doing is you're trading one bad business partner for another, from the government to the insurance company, when you go with these products, where you are a profit center for the company. Once again, if you go with a whole life policy, you're no longer a profit center for the company. You're a business partner of the company.
So let's get into some fun stuff, because anybody that has any issues about Chris explaining the IUL, our cousin American Dream TV is clearly an IUL advocate.
Okay.
I say take Chris up on his IUL challenge. He's giving $1,000. He's giving $1,000 for anyone that can disprove what he is saying. And I'm sure he's a man of his word. He'll be willing to pay you the $1,000 if your policy in itself is good. So before we transition to the other piece of what I want to talk about today, there was a question that was asked, Chris, that I would love for you to ask, because I think it's a good transition point. And it was, is there, and this is from Charles Riddler. He's one of my agents. And he was asking, is there a way to fund an IUL that makes sense for a client? And I would love for you to break that down, because this is a question that I actually asked you last night.
Yep. So there's two answers to this. There is not a way to fund an IUL for income that makes sense. It's just too risky. No matter what, you're not going to be able to take the risk off the table that inherently comes with an IUL and how they're designed. Where an IUL works and how you can design an IUL that works really well. I actually did a video on this. The way that IULs can work is what I call, it's called a single pay MEC, a single pay modified endowment contract. So if you understand what a modified endowment contract is, you lose the tax benefits, the tax-free nature of the cash value of the policy, but it's just leverage. So if you're somebody who's hitting retirement, maybe you're 55 to 65 or 70, and you're in good health, and you say, hey, I've got this extra pile of money over here that I really am focusing on, the just efficiency of the inheritance of my estate or whatever, passing on whatever I have to my heirs, it can be leverage. And when you do a single pay MEC, you're controlling the internal mechanisms of the IUL from a death benefit perspective, where you're really never going to have a problem with that thing lapsing. In fact, you can guarantee that that insurance is going to be in place for forever, right? And so you do it the right way, it becomes a leverage play from a life insurance perspective. And the good part about the MEC part is that, yes, you can still have some cash value. Now, for the person who's doing it, you don't ever want to have to tap into that money. Like, you don't want to do this with money that you know you're going to have to use. But let's say the sky falls, right? Like, and we go into a massive depression or whatever, you're not going to have the tax benefits of it, but any of the growth, anything above cost basis that grows to, you're going to have to pay taxes on it, but you at least have access to that money in case of a real emergency. And so from that context, in that situation, for that profile of an individual, a single pay MEC IUL can work extremely well. Now,
and moving from that, the IUL agents absolutely love to live and die by the illustration. And one of the biggest things I talk about, there's a difference between the IUL showing you interest gains and the permanent policy showing you cash gains. And why there's a big difference in that aspect. Can we talk about why IUL agents that sell policies love to depend on the illustrations, especially in the unguaranteed side versus the guaranteed side?
Yeah, I mean, they basically say that it's a conservative number, right? And so they don't know what they're talking about. If you look at the algorithm and you understand Regulation AG 49A, which if you don't know what that is, go look it up. But basically what Regulation AG 49A in the current column of the illustration, which is the current assumptions, which is saying, okay, if it's running it at 6.2% or 6.4% or 5.8%, whatever that number is, it'll tell you up in the corner. It's saying this number is calculated based on AG 49A, based on an algorithm, right? Based on a calculation that they have. And what happens is, if you look at how that regulation is created, it's basically saying it's 50-50 whether it's going to perform year in, year out, above or worse than that, right? And if you go down, like I was just looking at one yesterday, you can look, and not every company does this. Some of the, I guess, more reputable companies are a bit more transparent. I can't remember the name of the company I was looking at yesterday. I want to say it was Mutual of Omaha, actually. But when you looked at the bottom end of it, it actually said this policy, based on the 25-year back test, you know, we're showing you 6.2%, but it could be as bad as 3.49% and as good as, you know, it was like 6.7 or 8%, right? So the downside was actually way worse than what the upside was compared to what the illustration showed. And it basically tells you straight up, this is not going to happen. And so you have to, if you read the fine print of every IUL illustration, you get way beyond the numbers. And listen, it's easy to get bought into this because, let's face it, we live in this world where these IUL illustrations are 40 plus pages long. And there's a lot of legal jargon. There's a lot of like big words and concepts that people just don't understand. And so it's easy to just like point people to a thing and focus on the, hey, look at the 6.2% there, and this is what it does, and you're going to have the downside protection and the upside potential and this and that, and they tell them this is going to be how it's going to be, but they don't even understand how regulation AG 49A works. They don't understand when they're illustrating income on this, there's 50 basis points of positive arbitrage baked into the illustration that, by the way, is going to go away when regulation AG 49B comes out, and they don't explain how the cap rates work. They don't explain that this is all based on current assumptions of cap rates, par rates, spread charges, all these different things that go into the fees. The cost of insurance could go up, all these things. It's all based on the fact that this policy is going to perform really well out of the gate. The net amount at risk in the insurance policy, and I know I'm sorry, I'm talking over people's heads probably in some cases because like this is all real technical jargon that is confusing that most agents don't understand. And what most agents don't understand is the negative consequence when these policies start to go awry and start to have bad years. We always talk about the positive nature of compounding. The problem with IULs is that you get the negative nature of compounding. All these fees, all these charges, the cost of insurance, all this stuff, because the net amount at risk in bad years goes up. That increases the insurance charges. None of it is shown on an illustration. Only the positives, none of the negatives. And the negatives are slid into these really complicated statements written on the illustration. And so agents just focus on the positives, eliminate the negative mindset. And if you buy this just on the like it's just smoke and mirrors, man.
So to be clear, because I do want to pause here for anybody that won't smoke on your challenge, in the middle of all this amazingness that you got, because I don't want them to get confused that my brother has absolutely told you all that he has $1,000 on the table for anyone that can take him up on a challenge. So the parameters for the challenge is not, ooh, he got the paper. So what he's saying is, what he said was, it's not about structuring a new policy. We want to see your policy from the last 10 years.
Yep.
From the last 10 years. Oh, go ahead.
Yeah, so, and it's got to be 10 years because I don't want to hear, oh, I'm 3 years in and my policy's doing great. That's great. It's great that it's doing great when the insurance company controls all your money. Good for you. As soon as you start getting more control of your money, they're going to reduce the performance. It's not going to do well. That is the point that I'm trying to prove. Everybody that wants to argue with me, the people that like to puff up, and come against me have been doing this not long enough to actually be able to fight back. So they just try to stand on their mountain without ammunition. You're firing blanks, bud. Like I promise. Like the people that have actually been in the industry long enough, they go in their cave and they hide from me because they don't know what to do. That's what it is. And so here's the thing. Here's my call out to any PHP agent, WFG, PFA, any like ridiculous IMOs. Like, you've been in this business for 3 years, 2 years, 1 year, 5 years, whatever it is. I hope to God you have a mentor that you're trusting that has been doing this long enough that if you can't do it, you better go to them and ask them to step up. And if they can't prove it, I challenge you to have the integrity to do what you need to do to make the right decision from here forward.
All right, so let's do this. I want to put this on the screen. Where can they go if they won't smoke? What do they email? Where do they go, Chris?
Oh, they can always email me, Chris@life180.com. I can't believe I put that email out there for everybody, but it seems to work, you know. Chris@life180.com. And honestly, if you really want to learn about this stuff, go to my IUL training playlist. I've got a playlist on YouTube that is 54 videos long, talking nothing about the internal workings, the inside outs of everything IUL is. Like how they work, how the charges work, how they set the cap rates, how the option strategy works, why they do what they do, like literally every component that you could ever imagine over 54 videos. And make no mistake about it, like you better get ready to nerd out because it's not simple. It's complicated. And that's why it has to be broken down over a lot of different content, a lot of different videos. But here's the thing. If you want to live a bigger life, you gotta be willing to dedicate yourself to this. There's nowhere else in life. And I know I'm probably preaching to the choir because everybody's here is dedicated to like investing in themselves and doing this. But Jake, I mean, you and me, right? We're married. We got kids, right?
Yes, sir.
So are you going to outsource your responsibility as a husband to anybody else in your life?
No.
Are you going to outsource your responsibility?
Father.
Or father? No, you're not going to, right? Is there anything more important than your faith and your family in your life than money that has an impact on the rest of your life? No. So why the heck has everybody in this country, in this world, been somehow convinced and duped that it's in their best interest to give up control and responsibility of learning what they need to learn about their money to get the results that they want in life? It doesn't work in any other area. The successive principles are non-negotiable. You need to learn this stuff.
Man. Oh my gosh. Okay, y'all. Shoot. Listen, I thought I was alone on this mountain. That's why I'm smiling from ear to ear, bro, because anybody that knows Dr. Jake, they know like this is something that I fracking just cannot stand, and I'm willing to go against anybody. So let's go to the lighter side, so we can let the steam kind of spread. Right. Let me ask y'all this question in the chat. If y'all are loving this and y'all happy to know that there's an ebony brother, an ivory brother that's out here with the same fire that Dr. Jake has, let me see some fires in the chat. Let me see some fires in the chat. Let me see. Olivette Payne said, "You're right. We are ready." Chris said, "I'm so happy to hear the truth. Thank you, guys." I mean, this is just great. We got fire in the chat. We got hundreds. We got excitement. We got some people that love to hear the truth. And then at the end of the day, if you do not like what we are saying, you can challenge Chris or you can challenge me. It's just fine. It's okay. I like a duel. I like a good duel. So now let's talk about this. Let's go to the scheme of the marketing ploy, right? Which is, and you and I both believe in this, private banking or infinite banking or banking on yourself is a process, not a product.
Of course.
Okay. Yeah. And there are so many people that are like, just with $200 a month, you can be your own bank. Can we talk about how that isn't necessarily the truth? And it takes time. And I want you to kind of even go deep last night when we were talking, how it is a forced savings until you can bank. Can we get into that?
Yeah. So here's the deal. My foundational belief on this stuff is like, we need to pay ourselves first. That is once again, a financial principle that's kind of non-negotiable. Unfortunately, most people with their finances, they spend their money on their bills and their lifestyle and their expenses, and they try to save what they have left at the end of all that. And for most people, that's nothing. That's not enough. And so what we need to be doing is we need to commit to a plan where we save our money first, where we pay ourselves first, and then we pay our bills with what's left. And what you'll find is your habits, if you really start implementing that mindset, your habits are going to change drastically over time, and your life will start to change with it. That said, I'm a big believer, you know, Jake and I were talking last night. I'm a big believer that everybody's in a different place. Like if you find yourself where you're in debt right now and you're kind of jacked up financially and whatnot, you know, some people are going to be in a place where you just need to go get a convertible term policy, get life insurance protection, get it in place to make sure your family's protected, and really pay down that toxic debt, come up with a plan and do that. But I'm also a big believer that if you can, we should be stretching ourselves, because nothing happens by sitting in our little boxes of comfort, right? I'm a big believer success lies outside your comfort zone. So you need to be leaning on that wall of discomfort and getting uncomfortable. Now, you don't want to be irresponsible about it, right? Like you don't want to take uneducated leaps. Same principle with business as it is with money. Like you don't just blindly jump into something without understanding it. So it's a process. With this, we want to be making sure that you are saving and paying yourself every single month. Now, what I do know is that if you say, hey, I'm going to wait and I'm just going to save in a bank account until I get where I want to go, I got news for you. You've probably been trying to do that your whole life, so it's not going to work now. You know, you need to set up a different system. Now, you're not going to be able to start doing banking, but what I love about whole life insurance, and I say this every day to people at some point in time throughout my day, I swear this comes out of my mouth every single day, a properly designed whole life insurance product is the only financial tool in the world that will make sure that what you want to happen will happen when you want it to happen, whether you're here to see it or not. Let that set in. Okay. Properly designed whole life policy is the only product in the world that'll make sure what you want to happen, when you want it to happen, whether you're here to see it or not. Right. And so with that, what do I mean by that? I'm saying we need to save money. You need to save money. If you save it in a bank, you save it in a whole life policy. You're not going to be implementing banking when you start your whole life policy if you don't have a bunch of money to put in up front. If you don't have all this stuff right out of the gate, you're not going to be able to implement banking principles.
Bro, no. I'm not about to let you drop these gems and just roll over it.
Okay.
No, we got to sit on that. We got to sit on that.
All right.
You are not practicing banking unless you have a lot of income to dump into your policy. Can we talk about that? Because a lot of people are not ready for banking, to be honest.
Sure.
And we need to save cash, dump that cash monthly, get used to the discipline. Then when that cash builds up, you can start practicing those principles. But can we sit on that for a little bit? Can we sit on that?
Sure. Let's do it. So banking, think about it. Banking is what? It's the implementation, use, and the velocity, the movement of the money inside of your policy, and eliminating, taking over the banking function of your life, right? Like that's what that's doing and that's where you control all this, and you're recapturing the expenses and the costs and the fees and everything that you typically transfer to a bank, and you're controlling that. And so from that perspective, when you first start, if you first are starting with $300 a month into a policy and you design that policy right, you're probably going to have $200 to $240 a month of that. That's going to be a forced savings. And the rest of it's going to go into insurance, because let's face it, you probably need both, right? And even if you don't, over a long period of time, that savings plan, that forced savings plan is going to help you get where you want to go. And it's going to force you and hold you accountable to your own goals, dreams, and visions, right? Like, and help you get closer to where you want to go. Make no mistake about it. When you save that $300 a month, you're not banking with anything. You have a safety account. You have an emergency fund. You'll have money there, but you're saving an emergency fund, and you save up an emergency fund first. And the best place to save it is in a life insurance policy, a properly designed whole life insurance policy. Why? Because if I save that money up and I've got a wife and 3 kids like I have that are 11, 8, and 4, and I'm saving my money there, and I get killed tomorrow in a car accident, or I get diagnosed with cancer, or something bad happens, guess what? I know that what I want to happen will happen when I want it to happen, whether I'm here to see it or not. Because even if my life doesn't continue and I can't keep saving, I can't keep down that journey. A properly designed whole life insurance policy is a self-completing plan. It's gonna all take care of itself, even if my life derails, right? It's gonna take care of itself. Now, if everything keeps going the way that I want it to go, I'm gonna keep saving, and eventually I'm gonna have enough money there. I'm gonna have my emergency fund capitalized, and then I'm gonna have an opportunity fund capitalized. And as soon as I have both those things capitalized, now that policy becomes a banking policy. Until that point in time, until it's properly capitalized and funded, and I've become who I need to be to execute with that properly, and I've learned the principles, and I've built myself. Until that point in time, it's not a banking policy. It's just an emergency fund, and it's an opportunity fund. It becomes a banking policy when you become the person you need to be to execute and implement.
Chris said, when I become who I need to be, only then will I be able to actually understand the concepts of private banking. I got two more questions for you. The first question is, we have the 60-40, 80-20, 70-30, 90-10 for the people that really are practicing. When is it, let's just say 60-40, 80-20 splits. When is it a good a thing for the agent to put somebody in the 60-40 versus an 80-20, if you can kind of dive into that a little bit?
Yeah, I mean, I think it just is a little different with everybody. Once again, I think if you're thinking about it just 60-40, 80-20, what you're doing is you're commoditizing the whole policy, and it can't be about that. It's got to be about what your objectives are. If you're thinking 60-40, 80-20, you're thinking short term. And the principle that we're always trying to teach, you got to think long term. And I'm saying this, I'm not against the 1090 policies and the 2080 policies, and I'm not against those. But what I will tell you is those typically come with a long-term cost, right? I started off by saying there's no free lunches in this world. Life insurance companies are actuarially based, and they're not going to give you more short-term liquidity and more long-term growth. It's one or the other. So you don't, typically speaking, if you do a 1090 policy, it depends on the individual. It depends on who you are. It depends on where you are in your life and your skills and your ability and who you are, right? Like, so the value of a 1090 policy and the liquidity of that money and the control of that money is worth different amounts and different returns. And it's got a different value on it for every person in the world, right? Like the value of access to that capital is worth different amounts of money compared for me or Jake compared to a lot of people watching this video. And once again, if you're not who you need to be yet, and you got a journey, what I would encourage you to do is don't even think about, if you can't buy this concept and buy into it and say, this is where I want to save my money without looking at an illustration, you shouldn't buy it at all. You need to do this. Now, the illustration needs to make sense eventually, but what you have to do is you have to start with the end in mind. You have to start with what are your objectives, and make sure that wherever you put your money is in alignment with your values, your beliefs, your goals, your objectives. And when you start doing that, you start to realize, like, most people look at a whole life policy and they go, oh, I want a 90-10 or a 10-90 or a 40-60 or whatever it is. And depends on who you talk to. And they go, this is what I want. And what you're doing, anybody who has that argument or conversation is typically looking in the first 3, 4, 5 years of the policy being like, ooh, this one has more liquidity. That's what I want. Look 30 years out for me. Tell me what it looks like then. Tell me how that policy versus this policy is going to align with where you want to be then. You got to stop. Here's what I know, Jake. People way overestimate what they're going to do in the next year, and they way underestimate what they're going to do in the next 20. Yeah. That's it. Yep. So start having a little more faith and confidence in yourself long-term and commit to a long-term plan. That's and then design your policy around what your long-term visions are. Because if you think short-term with every decision you make, you're never going to get anywhere.
And I tell people all the time, Chris, there is no strategy that's a cookie, because every strategy should fit what your end goal is for yourself and for your family. Chris, where can they find you on YouTube and Instagram if they wanted to continue to learn from you and get some game? Because I can't be the only one that they're getting game from.
No, it's good, man. So I'm on YouTube. It's youtube.com/life180, LIFE 180. It's real simple. And then on Instagram, I'm real Chris Kirkpatrick, REAL, and then my name is written there, Chris Kirkpatrick. It's the same on TikTok. If anybody's on TikTok, I'm on there as well. But yeah, man, I love this stuff, man. I have so much fun talking to you. This is the highlight of my day right now. This is so much fun.
I appreciate that. Well, Chris, I appreciate you coming on, I guess, the show. for my first interview.
The show, the new show, the Smoke Kings show. Here we go.
The Smoke Kings, come on. The Smoke. Hey, listen, hold on. Let me just do a little poll in the chat. If y'all want us to create a new podcast called Smoke Kings, where we're teaching y'all the real game of insurance, business on the business side as agents, as well as clients, and then calling some people out that's out of line. Let me see Smoke Kings in the chat. Let us see a little something. Let's see if it's somebody said, give me that, Dr. J. Doc. So look, let me see Smoke Keys in the chat if there's something that you're interested in. But until then, y'all, they going crazy. Until then, please, y'all chime in to Chris. Y'all know I don't endorse anybody. Anybody that knows me, y'all know I don't endorse. I don't like endorsing because a lot of people out here be having smoke screens, right? That's why you need the Smoke Kings to go in and fan it out. But but the thing is, it may even attract some people that like to smoke weed, Chris, because they may be so high that they come on our channel and learn some business. So I'll
be like, what is this? Yeah.
What awesome. Is this? So y'all, I appreciate you, Chris. I'll give you the call here in a second. I appreciate your time, brother.
Love it. You too, brother.
Awesome. All right, so listen, y'all heard it. That's my brother Chris. He is absolutely off of the freaking fracking chain. Y'all seen it. We're going to do some business together. We got to get Ebony and Ivory out here so they stop jumping my brother, okay? I done been trained to fight people that know how to jump, okay? I bring a GUNN, guts under no circumstance. So this is what I would tell you, y'all. It's good if y'all are interested in learning and becoming an agent because you've been in the industry, you haven't learned any of the stuff that we've been teaching y'all. Y'all can actually text agent to 281-524 agent to 281-524-3973. And then also for those of you that want to learn private banking at the highest level, where we actually teach you and train you the concept of private banking, text bank to 281-524-3973. And please go and subscribe to Chris' channel. Go and follow his Instagram. It's okay to like more than one person talking about the same thing. There's enough to go around. It's all okay. And if you want to get a policy with him, you like him a little bit more than me, go ahead, patron his business. But just know at least you're doing it the right way. Other than that, I'll see you all next time. And